Most new grads make a massive financial mistake on their very first day of work. It happens during onboarding. You're asked, Roth or traditional? Most people just click whatever the HR rep suggests or pick the default option. But if you're in a specific tax bracket, that one simple click could cost you over $100,000 in taxes by the time you retire. We've analyzed hundreds of retirement scenarios to find exactly where the tax bracket trap hides. Our goal is simple: helping early career professionals turn their first corporate paychecks into lifelong wealth. In this video, we're breaking down the Roth IRA versus the 401k. I'm going to show you the bracket rule to determine which account you should prioritize right now to maximize your take-home pay. By the end of this video, you'll know exactly how to set up your accounts to keep your money away from the IRS and in your own pocket. Let's dive in. Here's the reality. When you start your first corporate job, HR hands you a benefits package. You see two options, 401k and Roth. Most people just check a box. Maybe you asked a coworker and they said, just do the 401k, it's free money. That's the danger. Because free money doesn't matter if you're handing the government a massive check later. See, there are only two ways the government taxes your retirement. You either pay the taxes now or you pay them later. If you're in a low tax bracket now, which most new grads are, and you choose a traditional 401k, you're essentially betting that your tax rate will be lower when you retire. But look at the history. Tax rates have a habit of climbing. Imagine you're 65. You've successfully saved $1 million. You go to withdraw your funds, and suddenly, the IRS takes 25, 30, or even 35% of it. That is a six-figure mistake. $100,000 gone. Not because you didn't save, but because you picked the wrong bucket. You worked 40 years for that money. Why let the government take a massive slice of it just because you spent 30 seconds on an HR form in your 20s? So, how do you avoid the $100K trap? It all comes down to one simple question. Do you want to pay taxes now or later? Most people pick based on what feels good today. They want a bigger paycheck right now. But that's how the trap works. To win, you have to understand the tax bracket logic. Let's break down the 401k first. Your 401k is typically pre-tax. This means the money comes out of your check before the government touches it. If you earn $60,000 and put $5,000 into your 401k, the IRS only taxes you as if you made $55,000. It feels like a win today. But here's the catch. That money is just on a tax holiday. You aren't avoiding taxes, you're delaying them. When you withdraw that money at age 65, the government will tax it as ordinary income. Now, let's look at the Roth IRA. With a Roth, you pay taxes up front. You earn your money, the government takes its cut, and then you invest what's left. It feels worse today because your paycheck is smaller. But here is the magic. Every single cent of growth is tax-free. If your $10,000 investment grows to $100,000 over 30 years, you don't owe the IRS a dime on that $90,000 gain. This is where the $100,000 mistake happens. If you're 23 or 28, you are likely in the lowest tax bracket of your entire career. Paying 12% or 22% now to avoid paying 30% or 35% in the future is a mathematical no-brainer. Imagine you retire with $1 million. In a traditional 401k, at a 25% tax rate, you owe the government $250,000. In a Roth, you owe zero. That's the gap. That's the mistake. So, what is the actual strategy for a new grad? Follow this hierarchy. Step 1, contribute to your 401k only up to the employer match. If they match 4%, you put in 4%. This is a 100% instant return. Never leave free money on the table. Step 2, max out your Roth IRA. Get as much money into that tax-free growth engine as possible, while your income is still relatively low. Step 3, if you still have money left to invest, go go back to your 401k and fill it up. By following this order, you optimize for today's match and tomorrow's tax freedom. You stop the leak before it costs you 6 figures. Now, knowing the difference is one thing. Actually executing the strategy is where most people fail. That's why I recommend using. It automates your contributions and helps you visualize exactly how your wealth grows over time. No more guessing games with tax brackets. When you stop guessing and start automating, you stop leaking money to the IRS. Imagine hitting your first $100K not because you got lucky, but because you had a system in place. If you're ready to stop the tax leak and start building your passive income stream, click the link in the description to get started with. And if this video saved you from a massive tax mistake, hit that subscribe button. Let's build that wealth together.